Almost everyone assumes that buying an apartment or house is a very profitable, low risk investment. I will put this statement to the test using data, statistics, and facts. In this video, I will tell you why I invest almost exclusively in equities and hardly ever in property. My logic is not the flawed one based on the myth property enthusiasts propagate. I will give you science-based reasons and share my findings, which are based on math and historic yields of different asset classes. This is in contrast to the wishful thinking or flawed math often used by real estate agents and YouTube personalities who promote their supposed property knowledge on social media. The following estimates are based on economic considerations and do not include any ideological or other preferences. Statements like paying rent is a waste of money, or I prefer to pay myself than to pay my landlord, are flawed logic. This propaganda of the real estate industry has unfortunately entered the minds of most people as a fixed set of beliefs, although it's incorrect. At first glance, it sounds logical that paying rent is a waste of money and that it is better to instead pay off a mortgage in order to become an owner yourself later. But upon closer inspection, this logic also turns out to be inaccurate. The first flaw is to compare investing in real estate with doing nothing or consuming all the money instead. This is obviously nonsense. Instead, one should assume someone who invests in the stock and bond market. If this calculation is carried out, apartment buyers and house builders usually end up with considerable smaller net worths than the stock market investors. Often the calculations are also carried out improperly to let real estate investments artificially look better. For example, maintenance costs are neglected or set too low, or additional initial purchase costs are ignored. In my opinion, there are two reasons for these errors. First, ignorance and incompetence among investors. Second, deliberate deception by the real estate industry, as they would otherwise find fewer interested parties. In order to compare the alternatives of buying versus renting, one first needs meaningful statistics. Unfortunately, these are not available for most countries. Data is only available for a few industrialized countries, and they often do not go back very far. Only the USA, Norway, and France have data going back more than 100 years. If one analyzes these from 1890 to today, one discovers that the long-term real appreciation of real estate, factoring in inflation, was only about 1% per annum. It should be noted that the value increases are probably even 0.5% to 1% exaggerated. The quality improvements are not sufficiently filtered out. Quality effects must be filtered out because these price changes are not based on market effects but on increasing quality. This adjustment is made for all consumer goods price indexes, but it is not or only partially made for real estate. If, for example, we have two identical houses next to each other, one of which is being modernized but the other is not, then the resulting price differences are not market-based but result from quality improvements. An example of such an investment would be the attachment of an elevator in a multi-story building or the installation of better sanitary facilities. From the data of the last 50 years for countries such as Germany, Austria, Switzerland, the Netherlands, France, Italy, Spain, Great Britain, Sweden, the USA, Australia, Japan, and South Africa, the following can be observed. The average annual price increase of real estate was about 1.5%. The lowest growth was in Japan with only 0.2%, while Germany was also far behind with 0.6% per year. The top performer is Great Britain with 3.3% annually. The US is roughly in the middle with 1.6% annual real estate price growth. It should be noted that prices in most of the countries under review have risen particularly sharply in the last 10 years. Germany real estate, for example, had a growth rate of 5.3% per annum from 2011 to 2020. In Sweden, it was 4.1%, and in the US, it was 3.5%. This is likely due to external factors such as zero interest rates around the world. When bonds and saving accounts no longer yield a return, investors try to invest their money elsewhere to generate a return. These external factors are now gone for the most part. You could even argue that they now are negative for properties. Due to massive inflation, central banks have been forced to raise interest rates, which makes real estate less attractive compared to other assets such as governmental bonds. Higher interest rates also have a dampening effect on the real estate market in other ways. Debt financing, which is the norm for real estate, is now becoming significantly more expensive. Real estate prices show regression to the mean. Every decade with above average price increases tend to be followed by a decade with worse returns. Anyone familiar with the exorbitant price increases in Germany in the last 10 years may draw their own conclusions. Real estate is also much riskier than commonly thought. It is often claimed that apartments and houses are very stable in value. This is a widespread misunderstanding. Just because you are not presented with a stock market price every day does not mean that this asset class is not also subject to strong fluctuations over time. The aforementioned data of the 13 countries show that the maximum cumulative drawdown, the maximum price decline, can be up to 52%. The largest drawdown was measured in South Africa with 52%, but countries such as Japan and the Netherlands are only marginally better with a maximum cumulative measured price decline of 48% each. In the US, this figure has been 39%. Best performers are Australia and Switzerland with 13 and 24% maximum cumulative drawdown. The share of years with negative real appreciation was 40% across countries. This meant that, on average, inflation-adjusted residential property prices fell in 4 out of 10 years. The interim conclusion from the data presented is as follows. The long-term increase in value of residential real estate is smaller than many people assume. Even the real estate boom of the last 10 years does not change this. Based on the last 50 years, one should realistically expect long-term appreciation of only 1 to 2%. The widespread overestimation of value increases is due to a combination of factors. First, we are fooled by inflation, nominal appreciation, and nominal returns. Example, if your property increased in price 5% this year, but the inflation is 10%, you are still losing money in real terms. Second, we fall for selectively chosen numbers and forecasts from real estate industry, banks, the media, colleagues, and friends, which are mainly short-term historical figures with many flaws. Third, we all engage in wishful thinking. Similarly, we underestimate the risk of negative value fluctuations/losses. The same factors are largely responsible for this misperception. In addition, there are the repeated statements in the media according to which real estate is safe and stable in value compared to stock market investments. This is particularly insidious and objectively wrong since about 15 years ago, households in the USA, Great Britain, Ireland, and Spain suffered enormous losses with credit financed home investments, in some cases to the point of complete financial ruin. Of course, these figures alone do not mean that real estate investments cannot be a sensible economic decision. But they do show that the idea of a safe, low volatility investment that always increases in value over the long term is a naive fairy tale which you should not fall for. Buying or selling a property comes with additional transaction cost. These closing and additional costs are significant, especially compared to other investments such as stocks or bonds. Germany and Austria are particularly expensive in international comparison. In Germany, additional purchase costs can be as high as 12%, while in Austria they can still be up to 10%. As an example, the additional costs from Germany are mentioned here. The mandatory notary will be about 1%. The land registration fees are about 0.5% on average. A real estate agent costs about 6%. In Germany, the costs are typically shared between buyer and seller. The so-called Grunderwerbssteuer or property transfer tax is 3.5% up to 6.5%. It varies depending on the region you are buying at. High additional purchasing costs have a particularly negative impact on returns if the property are held for a short time only. So-called flipping of properties is not an option in Germany if you are looking to make a profit. The ongoing costs of real estate are also far greater than those of capital market investments. The main expenses are: first, taxes; second, insurances; third, cost for the administrator; fourth, payments to an owners association or a management committee, if only one unit is owned in a bigger complex, for example. Fifth, maintenance costs. Sixth, interest and repayment of principal. Maintenance is an especially huge factor. Typically, costs are set at 1% of the purchase value or less. This is unrealistic. On a long-term average, 1.5 to 2% of the purchase price is required, but hardly anyone sets them this high. Sure, often you hardly have any repairs for years, but when all of a sudden a huge repair is needed, such as the restoration of the roof, should you now question why I set such a high repair cost? Here is my reasoning. First, the allowed depreciation on a yearly basis for properties in Germany is more than 3%. The allowed depreciation is the result of a political negotiation between property owners and the tax office. The former wants to set a particularly high value for obvious reasons. while the government wants to keep it particularly low. One meets where both arguments are about equally good, so close to the actual loss of value through physical wear and tear. Second, according to the so-called Petersche formula, the estimated annual maintenance costs for multifamily buildings amount to 1.88% based on the production cost. Detached single-family houses are subject to a higher physical loss of value due to technical and construction reasons. But even large property managers with thousands of apartments report maintenance costs of over 1% usually, sometimes even up to 2%. It should also be noted that these companies, due to their size, are probably about 1/3 more cost efficient than the average homeowner. Fourth, even US economists at the Federal Reserve Bank of Cleveland take 2% as a good benchmark. Two US economists, Ackett and Masturso, 2016, in their paper Next Season's Meager Harvest in Commercial Real Estate, also assume 2% maintenance cost per year. Since the average construction costs in the USA are lower than in Germany, for example, the rate in the latter can be assumed to be approximately 1/3 lower. Depending on the construction method and cost, you can adjust the cost accordingly. If you want to compare buying and renting correctly, you should make the following calculations. The real estate investor has the following relevant cash flows. Case 1, the investor is self-user. Minus down payment for the property, including all additional costs like real estate agent, minus tax and fees, minus mortgage costs, minus maintenance and other running expenses, plus proceeds of the sale of the property, minus taxes and additional costs of selling, like real estate agents, for example. Case 2. The investor is not self-occupying his property. Minus down payment for the property, including all additional costs like real estate agents, taxes and fees, minus maintenance and other running expenses, plus rental income minus rent in a different property to another landlord, plus proceeds of the sale minus taxes and additional costs of selling, like for example again the real estate agent. The relevant cash flows for the renter and capital market investor are minus purchase price of assets including transaction costs, minus ongoing investments year over year, minus rent plus ongoing returns from the investment, like for example dividends and interest payments, minus taxes plus income from the sales of assets minus transaction costs and taxes. There are many scientific studies on historical returns on residential real estate or buy and rent comparisons for different countries and large cities in different time periods. If you don't believe me, you are welcome to consult one of the shown sources. Almost all studies conclude that renting combined with a capital market investment is more profitable than buying a property. This trend is likely to continue in the future. Contrary to popular belief, renting should actually be less risky than buying. This is especially true if 70 or more of the initial financing is loan financed and an alternative tenant invests his initial capital in a diversified buy and hold portfolio. This is due to the risk increasing combination of leverage, cluster risk, high illiquidity, high transaction costs, and interest rate risk, Let's break down the risks mentioned one by one. First, leverage means that debt service becomes significantly more expensive in the event of an upward change in interest rates. This can be observed in the UK right now. Due to the increase in interest rates, many homeowners are now in danger of losing their property because they can no longer afford to pay their loan under the new conditions. Second, cluster risk means not diversifying. The average property owner does not buy many properties in different regions and countries. On the contrary, often only one property is purchased. This represents a considerable cluster risk because a single property is far more risky in terms of long-term development of location. Will this be a trendy area too in 10 years or turn into a ghetto? The risk of loss in physical quality and the occurrence of insurance events is also much higher than in a diversified real estate portfolio of hundreds or thousands of buildings. Third, illiquidity means that you cannot sell immediately without having to take a lower offer. Another disadvantage is in stock portfolios, it is possible to sell demand driven. In other words, to only sell parts of the shares to cover current liquidity bottlenecks. This usually doesn't work for properties. You can't sell 1/20th of an apartment. You have to sell it or keep it. And in between is hardly ever possible. Fourth, high transaction costs were already discussed. It can be up to 12% in Germany for buyers of real estate, while stocks have no or almost no transaction cost. Although the risk of buying real estate exceeds that of stock investments, especially when financed with debt, as it is typically the case, most households assume that investing in apartments and houses is less risky. Reasons for this are first, ignorance and incompetence, second, wishful thinking, third, ignorance of leverage induced risk, fourth, misinformation in the media by advisors and the real estate industry. Another reason are house price indices. If you talk about property investments, a real estate price index almost always comes up. Such indices almost always run steeply from bottom left to top right and show hardly or only very mild fluctuations. One gets the impression of very low volatility. This is particularly the case if one compares the comparatively small swings with those of the stock market. This logic is flawed though. The first flaw is that price increases are usually reported in nominal terms, therefore include inflation. Secondly, neither maintenance costs nor rental income is included. This means that only the increase in value is measured, not the total return. Thirdly, the almost always used leverage is not accounted for either. What mainly leads to underestimating volatility or risk is that the real estate index consists of hundreds of thousands or even millions of buildings. This provides a smoothing effect. I will make an example since this is not immediately clear. Each individual share from the Dow Jones index will long term fluctuate more than the entire index, which represents a diversified portfolio of 30 stocks. The same is true for the diversified index compared with the single property. According to Kaufen oder Mieten 2021, the long-term real returns adjusting for inflation of different asset classes are 5.2% for stocks, 2.4% for residential real estate, 2% for long-term governmental bonds, 0.7% for gold, and 0.2% for other commodities. This dataset is comparing yields for the last 120 years from 1900 to 2019. The returns for properties include rent and price appreciation. If the numbers seem surprisingly low, don't be surprised. You belong to the majority of private investors who significantly overestimate their returns. It should also be pointed out that neither taxes nor transaction costs were taken into account in these figures, meaning the actual returns are even lower. There are several reasons for the widespread overestimation of returns. First, confusing nominal and real returns. Only returns with inflation factored in matter. Second, the non-inclusion of taxes and transaction costs. Third, wishful thinking. Fourth, selective perception. Fifth, overconfidence and hybris. Conclusion: returns on asset classes are overestimated by most investors. This also applies to residential real estate. The most profitable asset class are stocks, with real estate following far behind. If you look into the rent or buy question from a purely economic point of view, it is better to remain a tenant. There are even more reasons against buying self-occupied real estate. After buying a home, it is much more difficult to move, to take a better job offer far away, or to move in with your new love who lives 500 kilometers apart. Not everyone wants to become a landlord unintentionally. Should you decide to move, then the only option is to sell, often at a loss. Another disadvantage is that both self-inhabited and rent-occupied apartments require a considerable amount of time, which you do not have to spend as a tenant. Properties are not a typical passive investment. You will have to invest a lot of time for repairs, finding tenants, communicating with renters, and making decisions in property owner meetings in case of shared ownership. Investing in stocks and bonds using the buy and hold approach is way more time efficient. In other words, investing in real estate is not a purely economic decision. Instead, it is a lifestyle decision. For many people, it simply feels better to live within their own property. Another advantage is that you can shape living space as you want and do not have to rely on the permission of the landlord. If your only goal is to achieve the highest possible return, you are better advised to invest in the capital market. Please share the information with others who could also benefit. Don't forget to like and subscribe if you learned something. Watch this video next to learn how the optimal investment strategy for stock markets look like.